fair value gap that lines up exactly with this mitigation block. Now, a mitigation block is, think of like a breaker. In this case, we have a high, a low, a lower high that eventually went through. That is a mitigation block. Mitigation is a failed breaker, but they operate the same way. So in other words, treat it like real support and resistance. This high here ran through liquidity over here, came down, tried to rally once more, and was unable to get above the previous high, even through all of this. So anyone that would be long here, once we drop down below it, the concept of mitigation block is the same with a breaker. If someone on an institutional level is long, when it trades back to this level here, it allows them to mitigate that potential losing trade or drawdown, meaning that any longs here that are underwater, that means they're holding on to it while it's dropping against them. When it returns back into it, it's offer them an opportunity to mitigate. Order blocks don't mitigate, okay? Price isn't mitigating. So the object is, because this market rallied here but failed to take out that high, and we have a fair value gap there, our focus is to watch this one here. Now, more specifically, if we get through this fair value gap, the fact that we pulled back up to this level and it's a fair value gap, this level here to me is important because it can act as resistance. It can fail. In other words, fail to trade through it, which is what we would reasonably expect, because longs here that are underwater, they're going to want to do what? Get out of it. Not that it causes the market to go down because of selling pressure. It's allowing, the market's allowing those individuals that are using things outside of retail to get out of that long position. So what I like to do is I like to read the interpretation of each PD array, where they lay out in the chart. And because we are in a day or a morning session that has seen a large range expansion overnight in the London session, it's going to be a hard sell for people to want to be long. Now, it doesn't mean that the market can't go high, but I want to see a lot of things in my favor that would support a run. So what I'm watching is, do we respect this fair value gap with the mitigation block? Because the narrative would be this. We go up here to allow smart money to offset their longs that they had here that were unable to get off. Now, you're probably thinking, okay, if they're smart money, how did they end up in a position where they're losing? Because they're human. They're going to do what? They're going to speculate just like any of us. They're not artificial intelligence. The AI is the algorithm that's delivering these price movements. But the participation of this group of traders, they're looking for these types of things in price action to instigate some reason to be long or to get out of their position, or to get short or get out of their position. Now with this wick here, when we trade above that, I like to use the consequent encroachment of that as well, because we can have a retracement down, and it has 92.75. And this level to me would be important. I'd want to see it. It can stab through it a little bit, but I want to see if it trades down there. I want to see the body stay above it. Look at this right here. This is for folks that are struggling with my fair value gap. Look how this candle's trade down. The next candle we trade up, and then down. The next candle we trade up, almost completely closing in to that previous candle's low, and trade down. That's efficient delivery. There's no fair value gap here. It opens here, trades up almost to that candle, and then trades down. The next candle we open, we trade up and leave what? That small little gap right there. So if we do manage to get above this fair value gap with mitigation that's bearish, this would need to act as support, and then we would need to power through this one if we're bullish. This one here is just the first point of interest. I'm only interested in see initially what we're doing, because we're not rushing. We're still in the opening range. It's not even been 30 minutes since we opened. So we're only trying to get a feel for what it's likely to do, but not getting excited, because why? We had a big move overnight. Every retail trader in the world is going to be wanting to do what? Chase it. Chase it where it's been going down. So you have what? Stop loss orders that are resting right above this wick. They ran to that, to a fair value gap I've outlined with the logic as to why it should go to that one, because we have a mitigation block over here. So it's not just simply a, oh, this looks like a fair value gap, let me just put a rectangle on it and call it a fair value gap. No, there has to be some context as to why it would be even returning back to that level. Just because there's a gap, for instance, there's one up here, there's one right here, very small portion of it here, very, very little. The fact that we are in this area down here and this one here, why would I be interested in those and not suggesting something up here? Because if you look at the run from this low that we've created for the day, from the high overnight, where is these two fair value gaps? In the lower portion. So I'm wanting to justify, if smart money tried to go long here and they're utilizing this fair value gap and mitigation block to mitigate that long position or positions, they are thinking what? If that's true, if we can't get above this, it's being tipped, the market's tipping its hand that longs shouldn't be favored. So therefore, we could potentially grind eventually down into this low again today. I don't know that yet. I'm still observing the fair value gap, that mitigation block. And if we drop down any further, this is where I would want to see it stop. It can touch, the wick can touch this candle's high. If it did it all in one candle like this, that would be referred to as my immediate rebalance. Next candle, when you have a big up candle or down candle, the next candle opens and trades all the way back to the previous candle's high or low, creating no gap at all. That's an immediate rebalance. Usually when you see that, that's one of the sharpest, quickest takes off runs, and it doesn't give you the chance to get into it. Just to further, I probably confused some of you when I mentioned this range and what I was referring to. That's 50%. So this one here is still in a discount. So I want to see, does it have a reluctance to get to even 50% of that range, which would be what, equilibrium, or above it, which would take us into that fair value gap, which would be what, premium. So what I'm suggesting here in terms of narrative, what I'm trying to flesh out in terms of what I think is likely to occur is the fact that this fair value gap we've outlined and that mitigation block, smart money was what? Potentially long here. They went underwater, so they're in the business to make money. When the algorithm allows price to reprice back to an inefficiency and mitigation, they'll do what? They will kill their longs, and those longs being neutralized is indication to me as a trader, if it can fail here, that the better side is still looking for lower prices. And it would have done what? It would have gone up to take out the protective buy stops that were trailed in any shorts overnight. Retail would be trying to go short, thinking that this is resistance because it went there and stopped on a lower time frame chart. And this run here perfectly takes out any trailed buy stops, but it goes to a level that's, in my concepts, that makes sense. It's inefficient, mitigation. Now notice on the 5-minute chart, it doesn't look like a fair value gap. How is it when I drop down the lower time frame, the fair value gap that I have noted, there isn't a fair value gap on the lower time frame? That's fine. You would sometimes see that because these intervals are going to be much more busy. They're going to fluctuate a lot more. So they're going to overlap. You got 3 of these 5-minute candles that make up one 15-minute candle. So the fair value gap that I've outlined on that previous chart on the 15-minute time frame, you can't really see a fair value gap here except for the small little separation between this candle's low and this candle's high. That right there, that small little gap there, can be refined. So if you were looking at the 15-minute time frame, fair value gap, and drop down, you would refine it to that area right there because that is the actual fair value gap. So that's calibrating your PD arrays. You go from higher time frame down to lower time frame. And you can see how we go right up into it, hit it perfectly, and then we drop down to the consequent encroachment of that wick there. So from high of fair value gap, this would be mitigation. Smart money would be doing what? They would be killing their longs. That would be underwater as it dropped down below. And we are doing what? We are not even returning back to equilibrium yet. So in my opinion, it indicates weakness.